Good evening and welcome to KTN Business. April inflation has risen to a 7-month high, hitting 7.08% compared to 6.31% in March. The steady rise in inflation during the first 4 months comes as commodity prices continue to rise. And as Adelaide Changole reports, the rise brings sharp focus on the Central Bank's Monetary Policy Committee that meets next month, and whether action will be taken to ease inflation and prop up a weakening shilling is one that we are looking forward to.
Over the last 1 week, images such as this have played out on our TV sets as heavy rainfall caused havoc in many parts of the country. The effects were an ironic state of affairs given the fact that Kenyans pray for, plan for and spend a lot of time anticipating this rain. You see, Kenya's agricultural sector is heavily dependent on rainfall, and any shortage in this rainfall quickly translates into an increase in food prices. The recent downpours notwithstanding, the country has yet to receive its fair share of the short rains. As a result, the country's inflation rate, which measures how many shillings Kenyans have to spend to buy a number of goods, has gone up for the last 4 months. And according to the latest figures, the inflation rate has jumped from a 2.5-year low of 5.53% in January to hit a 7-month high of 7.08%.
Obviously, look at the weekly costs of buying vegetables in town, and they're expensive. And because they're expensive, the CPI is going to go up.
Inflation has risen 1.82% since March, driven by a 3.09% jump in the food and non-alcoholic beverages index, followed by a 0.57% jump in the restaurant and hotel index. However, despite the increases in diesel and kerosene prices, the transport index remained unchanged during the month.
It will be not going to surprise anyone, you know. It would be a perfectly expectable number. That's not saying that that's what the number's going to be, but it wouldn't surprise me if I saw the number there.
The rising inflation and a weakening shilling now turns the focus on the Monetary Policy Committee, scheduled to meet on the 6th of May. The MPC has left the central bank rate unchanged for 24 months at 8.5%. But with both the inflation and the shilling under pressure, the bank might be forced to intervene.
So when we talk of a stable exchange rate, we don't mean a flat exchange rate. We mean a predictable exchange rate, something that you as an investor can invest with security.
However, the government is optimistic that the upward trend will reverse by the end of the year as the effects of lower fuel prices and cheaper electricity are transmitted into the economy. Adelaide Changole, KTN Business.